Rotation indeed. I think that's the best way to describe what's been happening. Let's get right to it. It's now 2 weeks after we had that dip in technology stocks on June 9th. Everybody kind of freaked out. I wanted to sort of assess what's going on with the sector to start out right here. This is a look at some of the companies that have been doing well since that sell-off 2 Fridays ago. What we're seeing is a very different shift. Companies that led the tech industry in the first half of the year have basically fallen to the back of the pack. And instead, you've got companies like Alliance Data, Paychex, CSRA. These are companies that were a little bit cheaper that now are doing pretty well. I think basically what happened is that investors got a little bit scared about pricey tech. They moved out of some of the high flyers and they moved into some of these companies that up until now had been pretty cheaply valued. Let's move it on then to look at where that rotation actually looked on a sector basis. These bars are showing you the percent of companies in each relative index that are reaching all-time highs, or sorry, 52-week highs. What we're looking at here, over here in the red, is a very clear transition. First we had tech stocks that were hitting highs, then for a few days we had some financials. Now it's very much healthcare. And then finally, I want to pull it over to what a lot of people have been talking about, which is oil. But at the end of the day, outside the oil market, it doesn't seem like anybody really cares. If you look at the correlation back in 2015, 2016, when that oil bear market got real bad, stocks cared. This is the correlation of the day-to-day moves, and they reached a 5-year high. If you look where we are now, zero correlation. Doesn't matter what happens in oil, it's not phasing stocks. That might be because it's also not phasing the high yield market that much either. A lot of interesting stuff going on, good things to think about on an otherwise pretty slow Friday, guys.